How to create reliable retirement income without relying on the market. What happens if the market crashes the year you retire? It's a question most people don't want to think about, but it's one of the biggest threats to your financial future if you're nearing retirement. You've spent decades building your nest egg, saving in 401ks, IRAs, and investment accounts, but when it's time to start spending that money, everything changes. Suddenly, you're no longer adding to your accounts, you're taking from them. And if the market takes a hit right before you begin withdrawing, that's where problems start. This is known as sequencer returns risk, and it can derail even the most well-funded retirement plans, especially if you're relying solely on market-based investments to create your income. But here's the good news. Wealthy retirees and smart planners use a different approach. They know how to build reliable, predictable retirement income without being fully dependent on stock market performance. And in this video, I'm going to show you how to do the same. Whether you're 5 years from retirement or already retired, I'll walk you through a framework to generate steady income using tools that offer stability, flexibility, and peace of mind so that your retirement lifestyle doesn't rise and fall with the S&P 500. Hi, if you're new here, my name is Joshua Bliss, founder of Gateway Capital Management, now proudly under Balboa Wealth Partners. I've spent nearly 2 decades helping high-income professionals and retirees transition from saving to spending with confidence. And one of the biggest shifts I help clients make is this: going from growing your wealth to using it strategically. Because at the end of the day, retirement is about having the biggest account balance. It's about knowing where your income is coming from month after month, no matter what the market is doing. Let's talk about how to create that. 1, understand why market dependence is risky. The first thing we need to address is why relying solely on the stock market for income is dangerous. It all comes down to sequence and returns risk. Here's what that means. If the market drops early in retirement and you're withdrawing from your portfolio at the same time, you could lock in losses permanently, even if the market eventually recovers. That's because you're selling shares to fund your lifestyle at depressed prices, which leaves fewer assets behind to recover. Over time, this can drastically shorten the lifespan of your retirement savings. This is why the wealthy don't just rely on market performance, they create layers of income, some stable, some flexible, and some long-term growth-based. Let's walk through what that looks like. Use the retirement income bucket strategy. This bucket strategy is a powerful way to separate your money based on when you'll need it, which helps reduce the pressure on your portfolio during market downturns. Here's how it works. Bucket number 1. This is cash and short-term reserves, typically 0 to 2 years of income. Examples of this are high-yield savings, money market accounts, short-term CDs. This is your spending money, what you'll use for monthly living expenses. This helps you avoid selling investments in a downturn. Bucket number 2, conservative income investments, typically 3 to 7 years. Examples of this are bonds, fixed annuities, dividend-paying stocks, or structured notes. This bucket generates steady income and helps refill your cash bucket over time. Bucket 3, growth assets, typically 7 or more years. Examples of this are stocks, ETFs, real estate, or long-term growth strategies. This bucket is still working for you, growing and replenishing the rest of your plan over time. By dividing your assets this way, you give yourself a buffer against market volatility and create multiple sources of income you can draw from, not just stocks. 3, incorporate guaranteed income sources. Wealthy retirees often build a floor of income that they know they can count on no matter what the market does. These might include Social Security, pensions, annuities with lifetime income guarantees, rental income from real estate. Let's talk about annuities for a moment, because they often get a bad reputation. But when used correctly, they can play a key role in providing income stability. Some annuities offer guaranteed lifetime income, income you can't outlive no matter how long you live. Options to cover both spouses. They're not a growth tool, but they're a peace of mind tool. They remove the guesswork of what if the market drops right after I retire, because the income stays the same. Now, wealthy retirees don't put everything into annuities, but they often use them to cover essential expenses, so the rest of their portfolio can be more flexible. 4, build a flexible withdrawal strategy. One of the most overlooked parts of retirement planning is how you withdraw your money. It's not just about pulling 4% out and and hoping it lasts. Smart retirees and their advisors adjust income every year based off market conditions, tax planning opportunities, healthcare needs, and spending goals. Here's an example. In strong markets, you may pull from more growth assets. In poor years, you might lean more on bonds, cash, or annuity income. If you had large expenses, you may reduce next year's withdrawals slightly. You might do a Roth conversion in low-income years to reduce future RMDs. This flexibility helps your retirement plan adapt in real time instead of collapsing during rough markets. 5. Diversify your income sources. Wealthy retirees don't rely on just one income source. They build a mix. Here are a few examples. Tax-free income from Roth IRAs or municipal bonds. Taxable income from dividends, interest, and capital gains. Guaranteed income from annuities, pensions, and Social Security. Real estate cash flow from rentals or REITs. Business exit proceeds if they sold a company or still receive passive income. The goal is to create income streams that don't all move together. If one dips, another holds steady. If the market is down, your rental or annuity income might be up. This is how the wealthy protect their lifestyle, by not putting all their income eggs in one basket. You don't have to be rich to build income the way the wealthy do. You just need to be intentional, structured, and proactive. If you're within 5 to 10 years of retirement or already retired and want to reduce your market dependence, build income stability, and increase your peace of mind, book a call with me using the link in the description below. Let's walk through your income sources, spending goal, and risk exposure so you can retire with more confidence and less uncertainty. Because retirement shouldn't feel like a gamble, it should feel like a plan.